Hello, this is the 31st episode of What Would Peter Lynch Do, which explores the wisdom of legendary investor Peter Lynch. Today we're diving deep into a question from one of our curious listeners, and it's a big one. It really touches on an age-old investment riddle. Is it true that stocks that lead the stock market tend to continue to rise? And is it really better to buy rising stocks than buy falling stocks cheaply? Now, this isn't just about picking stocks, it connects to a broader life wisdom, something Peter Lynch often showed us. Understanding trends versus, true underlying value. Our mission today is to unpack two powerful and, frankly, seemingly opposite investment philosophies. That's momentum investing and value investing. We want to figure out what Peter Lynch might say, especially for you if you're perhaps newer to the world of stocks. We'll explore this idea of a lead stock strategy, get into the mechanics of momentum investing, and then really tackle that core question: buy rising or buy falling? Get ready for, hopefully, some surprising insights and maybe a few aha moments. Okay, let's unpack this then. The listener's question starts with this thing called the lead stock strategy. When we talk about lead stocks, what exactly are we looking for? I mean, what makes these companies really stand out? Why are they seen as so important?
That's a great place to start. Right. So lead stock isn't just, any company. It's a real powerhouse. These are the companies that are genuinely driving a sector, or maybe even a whole theme in the market. Think of them as the pioneers, the innovators. What makes them stand out? Well, first, they're market leaders. They're spearheading growth, often because of big shifts, new economic conditions, major industry changes, or, massive tech advancements. And they usually boast incredibly strong fundamentals. We're talking rock-solid business models, maybe unique technology that gives them an edge, a really strong brand people recognize. And crucially, they also tend to have very high growth potential. They're expanding market share, sometimes even creating entirely new markets.
So companies that aren't just large, but are actively sort of defining what's next. Can you give us some concrete examples? What does a lead stock look like in the real world?
Absolutely. Think about Apple during the smartphone revolution. They weren't just selling phones. They were completely changing how we interact with technology, right? Or Amazon, particularly AWS, Amazon Web Services. They basically created and now dominate the cloud computing space. And right now, you could point to NVIDIA. It's leading the charge in the AI era, absolutely essential for everything from data centers to self-driving cars. These companies didn't just grow alongside a trend, they led their revolutions. And when a company gets that lead stock label, it often develops sustained upward momentum precisely because of those strong fundamentals we just mentioned.
Okay. You've hit on something really important there, because what you're describing, this tendency for lead stocks to just keep climbing, that brings us right into the heart of momentum investing, doesn't it? What's the core idea behind that strategy? How does it actually work in practice?
Right. The core assumption of momentum investing is, surprisingly simple on the surface. A stock that's already going up is likely to keep going up. It's fundamentally about buying stocks that are going up, based on the belief that the trend will continue, at least for a while. The strategy relies heavily on trend following. You identify existing trends in stock prices and you buy in, hoping the trend persists. There's also a big psychological element here. I mean, when a stock consistently rises, it attracts more attention, more buyers, which can create this sort of self-fulfilling prophecy. The buying pressure itself pushes the price higher. Momentum investors often focus on a stock's relative strength, how it's doing compared to others or the market, regardless of the overall direction. And they use technical analysis quite a bit, things like moving averages or the relative strength index, the RSI, which can signal if a stock is maybe overbought or oversold. These tools help them gauge momentum and decide when to get in or out.
Okay, so that leads us directly back to our listener's core question. Is it really better to chase those rising stocks, or should you be looking for bargains among the ones that have fallen? From that momentum viewpoint, what's the main argument for buying high? Why do that?
Well, from a momentum perspective, buying a rising stock means you're essentially aligning yourself with a powerful market force. A price that keeps going up often signals a steady stream of good news, or maybe just concentrated buying interest from big players. It fuels positive sentiment, which strengthens the buying pressure even more. It suggests that, strong momentum tends to persist for a period. The reasoning is, even if a stock looks expensive based on traditional metrics, that higher price might already reflect positive expectations about the future. And if that momentum continues, there could still be significant upside. It fits perfectly with that old market saying, the expensive gets more expensive.
That makes sense from that perspective. But isn't the whole idea of value investing about finding those, diamonds in the rough precisely when they're down. How do you square that with the warning about don't catch a falling knife? What are the real risks when you invest in stocks that are already falling?
You've hit the nail on the head there. That's the direct conflict. Falling stocks, well, they're often incredibly tough to turn around. A sinking price frequently points to real problems with the company's fundamentals, or maybe eroding market interest, or just a string of bad news. That downward momentum can be just as powerful as upward momentum, pulling the stock further down as more people decide to sell. And this is exactly where that phrase, don't catch a falling knife, comes from. When a stock is plummeting, it's almost impossible to know where the actual bottom is. So many investors buy what seems cheap, only to watch it fall even further. It just ties up your capital and exposes you to potentially bigger losses while you wait for some unknown recovery point. Now, flipping that, you mentioned averaging up, buying more of a stock that's already rising. There can be a positive aspect to that. Strong momentum stocks, especially those late stocks we talked about, they often bounce back quickly after a small dip and just keep climbing. So buying during a minor pullback or averaging up, if you're confident in the continued momentum, could potentially boost your profits. But, and this is a big but, momentum eventually breaks. It always does. And predicting exactly when is incredibly difficult. Just blindly averaging up can lead to really significant losses if that stock suddenly turns and plummets.
It really makes you wonder, though, why isn't everyone just riding these momentum waves if they're so powerful? And why do these strategies, momentum and lead stock investing, seem particularly effective in the U.S. stock market specifically?
That's a great question. Yeah, there are a few key reasons why the U.S. market is sort of fertile ground for these approaches. First, there's just abundant liquidity. You have massive global capital inflow. The U.S. market acts like a magnet for international investment, and this drives high expectations, especially for companies showing strong growth potential. Second, it's just a hotbed for innovative companies. I mean, think about Silicon Valley. It constantly produces these groundbreaking companies that very quickly become new lead stocks. This creates powerful, sustained momentum waves. And finally, the speed of information is huge. News, data, analysis, it all spreads incredibly quickly. Combine that with very active institutional investors, and momentum can build and spread with remarkable speed. You're right, it is a dynamic place, but we really have to stress there's no single right answer in investing. It's helpful to think about it this way. Imagine value investors are like deep-sea divers. They're meticulously searching the seabed for hidden treasure that's the intrinsic value. Momentum investors, on the other hand, they're more like surfers. They're expertly trying to ride the biggest waves the market trends for as long as they possibly can. Their core goals are just fundamentally different. These two strategies, momentum and value, are generally seen as opposing or at least contrasting because their goals, their analysis methods, even their decision-making bases are quite distinct. Let's quickly break down value investing first, just to be clear. The core idea is simple. Buy stocks trading for less than their real, underlying worth their intrinsic value. The analysis is deep, meticulous. You're digging into financial statements, revenues, profits, assets, debts. You're looking at the business model, competitive advantages, management quality, all to figure out what the company is truly worth. The decision rule: buy when the market price is significantly below that calculated value. Then you wait patiently for the market to recognize that value, or you sell when the price gets too high. The time horizon is definitely long-term. It requires real patience. This is where catching a falling knife can come in, but only after intense analysis suggests it's undervalued, not just because it's falling. Think Warren Buffett, Benjamin Graham, they're the icons here. Okay, now contrast that with momentum investing. The core here is to buy stocks that are already moving upwards, based on the belief that this trend is likely to continue. The analysis leans heavily on technical indicators, stock charts, trading volume patterns, moving averages, RSI. There's less emphasis on the company's fundamental health and more on market psychology, supply and demand dynamics, the persistence of the trend itself, the decision. Buy when you see strong upward momentum, sell when that momentum starts to fade or reverse. The time horizon is usually short to medium term. It can lead to quick profits, yes, but it also carries the risk of quick, significant losses if that trend suddenly breaks. It demands fast reactions. This is where ride the trend is the mantra. So why are they opposing? Well, it's a difference in focus, right? A value asks, is the real value high compared to the current price? Momentum asks, will the current upward price move continue? It's also a difference in when you buy. Value investors often buy when things look bleak, when a stock is unloved, seeing irrational pessimism as an opportunity.
Momentum investors buy when things look great, when a stock is rising, even if it seems expensive, expecting that positive sentiment to continue. They see concentrated market interest as the opportunity. At the end of the day, it's intrinsic value versus market sentiment driving the decision. Now, some sophisticated investors do try to blend them, maybe looking for fundamentally sound stocks that are also showing momentum. but the core philosophies remain quite different.
So, okay, what does this all really mean for us trying to figure this out? We know Peter Lynch and Warren Buffett are the quintessential value guys, but who are the big names on the other side? The momentum or trend-following champions? Let's maybe highlight a few well-known investors famous for these approaches. First, there's William J. O'Neill. He founded Investors Business Daily, IBD, and wrote the huge bestseller, How to Make Money in Stocks. He's famous for his Can Slim system. It's quite clever, actually. It combines looking for strong company fundamentals with checking for positive stock price momentum. He strongly believed stocks that go up a lot tend to go up even more. He wasn't afraid to buy stocks hitting new highs if the fundamentals looked good, too. Then you have someone like Richard Dennis. He was a legendary commodities trader, famous for that turtle trading experiment back in the day. He basically trained a group of ordinary people, the turtles, to be successful traders using a pure trend-following strategy. It was all based on technical rules, price action, not fundamentals at all, just betting that current price moves would continue. And maybe a historical figure, Jesse Livermore, a true legend from the early 20th century, known as the Great Bear of Wall Street. His philosophy, often captured in the classic book Reminiscences of a Stock Operator, really emphasized reading market trends and psychology. He made fortunes, and lost them, by gauging market sentiment and movement momentum rather than deep fundamental analysis. His famous line, "The trend is your friend," is like a guiding principle for momentum players. These figures are a real contrast to Lynch and Buffett, aren't they? But they also consistently aim to profit by leveraging how markets actually move.
Absolutely. And that brings us to the historical performance question. Which one actually does better? Well, it's tough to give a definitive answer. It's not like one consistently beats the other year after year. Their performance tends to cycle, often reversing, depending on the broader market conditions. But we can look at some general characteristics. Value investing historically is associated with something called the value premium. Studies over long periods, decades even, suggest that undervalued stocks, on average, have delivered better long-term returns, often with lower volatility too, making them feel a bit more defensive, especially in downturns. The big downside: value stocks can stay out of favor for a really long time, years sometimes. Or worse, they can become value traps, cheap for a reason, because the underlying business is actually deteriorating. Momentum investing, on the other side, benefits from the well-documented momentum effect. Stocks that have done well recently often do tend to keep doing well, at least in the short to medium term. So, momentum strategies have a high probability of generating pretty significant returns, especially in strong bull markets, particularly when led by those innovative lead stocks. But, and it's a big but, they are typically much more volatile. They're prone to sudden, sharp reversals, sometimes called momentum crashes. And because you're trading more often, it can lead to higher transaction costs and potentially higher taxes. And the performance really differs depending on the market phase. Value stocks often shine during recoveries after a recession, or when interest rates are rising or staying high, or maybe after speculative bubble pops. Momentum stocks, conversely, tend to thrive in those strong, clear bull markets, especially markets driven by technology or growth stocks. Think about the tech rally after the 2020 pandemic. They also often do well in low interest rate environments where future growth seems more valuable. So what does the research say overall? Many long-term studies point towards that value premium over decades. But the momentum effect is also consistently significant over shorter to medium terms, and sometimes momentum has outperformed value quite dramatically over certain periods. Interestingly, some academic research even suggests that combining the two strategies, maybe filtering value stocks for momentum signals, or vice versa, might yield superior risk-adjusted returns because their performance patterns can be complementary. One does well when the other lags.
Okay, but that sounds complicated. It's easier said than done, right? Especially this idea of a hybrid strategy. Combining the best of both worlds sounds great on paper, but it needs a lot of experience, good judgment. It seems particularly tough for individual investors, maybe especially for beginners. So for you listening right now, if you're a novice investor, what's the most realistic, practical path to success here? We really want to emphasize two key points based on all this. First, and this aligns strongly with Peter Lynch, make value investing your foundation and maintain a long-term perspective. This is highly recommended for you as a novice. Why? Well, it's generally less complex than trying to time volatile momentum shifts. Understanding a company's basic business and financials is often less daunting than mastering technical charts and market sentiment swings. It also offers a more flexible time commitment. You don't necessarily need to be glued to your screen watching prices every day. That's much better for busy professionals or anyone everyone who can't dedicate full-time hours to investing. Plus, you get the benefit of compounding over time. Investing in solid, growing companies and holding them long-term allows that magic to work, letting the company's growth hopefully reflect in the stock price, maybe boosted by reinvested dividends, and perhaps most importantly, it provides psychological stability. Honestly, you'll probably sleep better at night. If you've done your homework and you're confident in the underlying quality of the companies you own, you'll likely feel less anxious during inevitable market dips. In fact, for a value investor, temporary price drops in good companies can even be seen as discount buying opportunities. And Peter Lynch gave some fantastic, really practical tips that fit right in here. Remember, invest in what you know. Start with companies whose products or services you understand and use. Focus on basic financials. You don't need a PhD in finance. Just check for things like consistently growing revenue, operating profit, net profit. Make sure the company doesn't have excessive debt. Keep it simple. Buy consistently and in installments. This is dollar cost averaging. Instead of trying to time the market perfectly, investing a fixed amount regularly over time helps average out your purchase price and reduces the risk of buying everything at a peak. And finally, approach with a mindset of investing for at least 3-5 years or more, maybe even longer. Don't get spooked by short-term noise. Trust in the long-term growth potential of the good businesses you've chosen.
Exactly. And that leads nicely into our second main piece of advice for you as a novice. Use momentum indicators only as a reference, not as your primary decision driver. Look, instead of trying to become a sophisticated momentum trader overnight, which is really hard, it's far more realistic to simply use momentum-related information like whether a stock price is trending up or down as just one supplementary piece of information. So let's say you found a company you like based on its fundamentals, your value analysis. If you then notice its stock price is currently trending upwards, okay, you can maybe interpret that as a sign that the market is starting to recognize its value, that interest is growing. But, and this is critical, avoid investing solely because of that momentum. The fundamental story, the value case, should always come first for this approach, and always understand volatility. Stocks with strong momentum, they can rise very fast, yes, but they can also fall just as quickly, sometimes even faster. For novice investors, that kind of rapid, sharp volatility can easily lead to panic selling or significant losses. And that goes against what should be your primary goal starting out. Not to lose money. Protecting your initial capital is paramount. While momentum investing holds the allure of quick profits, it absolutely carries the risk of quick losses too. Prioritizing the relative stability of value investing helps protect your assets while you learn. And this whole approach, making value investing your foundation, thinking long-term, using momentum only as a secondary reference, it aligns perfectly with Peter Lynch's core philosophy. Remember his key ideas. Invest in what you know. Listen to the company's story. Think long-term. He even acknowledged growth as a key part of value. Growth is a component of value. So at the end of the day, for most individual investors, especially those of you who don't have endless hours for deep stock research, focusing on your main job or career while consistently investing for the long-term and quality companies you understand. That is arguably the most realistic and achievable path to success. It offers time efficiency, it lets you harness the power of compounding, it provides crucial psychological stability, and importantly, it aligns with the time-tested wisdom of investing legends like Warren Buffett and Peter Lynch himself.
So, to wrap up our deep dive today, the big takeaway is this. While momentum investing is undeniably a powerful force, particularly in certain market environments like the dynamic U.S. market, for you, the new investor, maybe with limited time for constant monitoring and research, building that strong foundation using Peter Lynch's value-oriented principles, focusing on understandable businesses, solid financials, and crucially, maintaining a long-term perspective that really does seem to be the most realistic and likely the most successful path forward. And here's a final thought to leave you with, something Peter Lynch might appreciate. Consider how this core principle we discussed, identifying what holds true, underlying value, and staying committed to it over the long haul, despite all the short-term noise and fluctuations. Think about how that might apply not just to your stocks, but maybe to other important long-term goals in your life, or even to your own personal growth. Something to ponder. See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.